Hi world! This is the Frugal Millennial. It has almost been 1 year since our share market started to recover from one of the biggest crashes. So it's only fitting to talk about the events that led up to our market crash and discuss inflation, hyperinflation that everyone seems to be enthralled about. Today, I'll be doing my best to explain this very complex topic and give you background of what was involved that led us to see a crash. I'll be talking about the Australian market only, as our trajectory and events differ to that of other nations. This video is going to be a long one, so I have included timestamps. Before I begin, I should mention that I'm not a financial advisor. You should consider seeking independent financial advice to check how the information provided here relates to your own circumstances. At the beginning of 2020, Australia faced one of the worst bushfires seen in our recorded history, and we saw a contraction of the economy. As thousands of businesses were trying to recover from the devastation, the epidemic happened, which worsened the economy. When people realised how bad the epidemic was, panic ensued, as shown by the blue shade in this graph. Everyone was trying to get their money out, and hence the stock market kept plummeting. When the epidemic was upgraded to a pandemic status on March the 11th, the crash kept going. The Australian market fell almost 40%. When the borders closed, there was a sudden decrease in immigration, a drop in employment caused by the lockdowns, decrease in consumer sentiment followed. This meant money wasn't being spent, invested, or used for construction, etc. Australia was truly in a period of recession, as we saw 2 consecutive periods of shrinking economy. The GDP, or Gross Domestic Product, was the main way to gauge for recession. You can see the decrease in GDP during the first half of 2020 in this graph, as denoted by the red circle. We then saw a drop in the house price a few months later. This is because it takes longer to sell your house than it is to get money out from the stock, and hence there's always a lag in the property market compared to that of the stock market in times of financial downturn. In this graph, you can see that between the periods of May to around September 2020, most major cities in Australia saw a drop in house price, although Melbourne and Sydney kept decreasing in value until November. Like many other countries around the world, the Australian government injected stimulus into the economy, and we had a Jobkeeper program, which, as the name implies, helps employers to keep employing their staff. The Jobkeeper was introduced on March 30th last year and will stop at the end of today. More on this later. There were other incentives and programs that the government introduced, including allowing the withdrawal of $10,000 from their superannuation. And for those who don't know, this is our retirement fund. There was a relaxation of eviction laws, relief grants were issued, first homeowner grants were extended, introduction of home builder schemes. The banks allowed deferral of home loans to some people under financial stress. To combat low immigration and low foreign investment rates, the government also issued investor visas to allow foreign investors who can invest millions to take up temporary Australian residency. However, this had very little impact on our overall immigration rate. And the latest tourism and aviation package, just to name a few. Some of these schemes just seem to be a little bit too targeted towards certain sectors and not benefiting all industries. In Australia, our central bank, or the main governing body that looks after our money, is the Reserve Bank of Australia, or RBA. Its duty is to make sure our economy is stable, and this means to make sure our currency is strong, we have full employment, we have growth and prosperity, and the welfare of Australian people are looked after. They have power to make changes to a lot of the monetary policies to meet inflation targets, working to maintain payments, financial system, as well as issuing banknotes. Basically, just to make sure we grow as a nation financially. When the stock market crashed and the property market decreased, people's assets decreased in value. When the RBA saw this and that the economy was shrinking because people just ain't spending but rather saving it for a rainy day, they were worried. For the Reserve Bank, the only way to make people spend was to decrease interest rates. Now, how this worked is when people saw the cut in interest rate, the savings earned by simply putting their money in the bank just wasn't appealing. They looked to alternative investments instead. Here's a graph of the change in cash interest rate in Australia in the last decade. The rate itself is indicated in blue, whilst the red is the percentage of change in interest rate. You can see that we have not had a rise in interest rate in the last decade. Our rate currently is at 0.1%. If you look at the month of March, where the stock market crash happened, we had 2 lots of cuts in interest rate of 0.25% each. And in the month of November, we had a further 0.1% cut in rate. Now let's delve into why the interest rate cuts were necessary. Generally, people want money to work harder for them, so they look to other means to increase the value of their hard-earned money. In scenario number 1, depicted by the left-hand side, the cut in interest rate saw people look towards other alternatives such as stock market, gold, cryptocurrency, etc. You saw a recovery of stock market as mum and dad investors took charge of their money and invested in stocks. This then increased the overall wealth, which correlates to increase in general household spending. The other scenario, which is depicted by the picture on the right, you saw people take advantage of the low interest rate on home loans and bought properties, so the value of collateral as well as borrowing capacity increased. This, along with low supply of properties, led to a surge of property prices, even though there hasn't been any immigration, as people cannot come into the country. Just a side note, an increase in immigration is normally positively correlated with property prices. Some people were able to lock in on the low interest rate for home loans. The money they saved was then used on spending, which also led to the injection of money into the economy. However, despite the low interest rate, business loans decreased because there are negative sentiments right now, as we are not completely out of the woods with the pandemic. Lower interest rate also meant the government could borrow more money as they take advantage of the low rate. The decrease in interest rate has meant spending as a whole has increased. This also meant that GDP has increased. GDP growth data shows that our economy is slowly increasing as depicted by the green circle, but we are not quite there yet. However, there are a set of new challenges that have appeared. In February, we saw an increase in bond sell-off because people were worried that the rise in stimulus would cause inflation. And what is inflation? Inflation is the rate at which prices of goods and services rise. The higher the inflation, the lower the buying power, and makes your money worth less. For example, the price of coffee 50 years ago was cheaper than it is today, because inflation has made that same dollar worth less over the years, so you have to spend more money to buy that same cup of coffee. Because inflation has made that same dollar worth less over the years, so you have to spend more money to buy that same cup of coffee. Inflation maintained at a certain rate of 2 to 3% is seen as a good thing as the economy recovers. However, if the inflation rate is too high and the wage doesn't catch up, money can become even worth less and hyperinflation can happen. And this is where investors started to worry. People think that the inflation will be above the return they will get from their bonds, thereby holding onto bonds in the long run will actually make you lose money. So investors started selling that off to put money in other types of riskier investments. As more people sold their bonds, the price decreased, and this in turn made the bond yield rise. The RBA then stepped in and bought around $2 billion worth of bonds in order to keep the rate low, at around about 1.7%. And why is this important to keep bond yield levels low? Normally, bond yields are synonymous with interest rates. When bond yields fall, it results in lowering borrowing costs for corporations and government, leading to increased spending much like our interest rate. So if bond yields increase, the opposite will happen. The borrowing costs will increase and spending will decrease. This will make our economic recovery harder. Now I have oversimplified this because we haven't taken into account the relationship between bonds and shares, the price of bonds and yields, yield curves, etc. I might make a video about this later down the track. So will we be seeing inflation in Australia anytime soon? And when will the interest rate rise happen? Philip Lowe, the governor of the RBA, said recently in a press release, the Consumer Price Index, or CPI, which is an index to measure inflation, increased by 0.9% over the year to December quarter, and wage as measured by wage price index, are increasing at the lowest rate on record. Both inflation and wage growth are expected to pick up, but to do so only gradually, with both remaining below 2% over the next couple of years. In underlying terms, inflation is expected to be 1.25% over 2021 and 1.5% over 2022. He then went on to say the board will not increase the cash rate until actual inflation is sustainably within 2 to 3% target range. For this to occur, wage growth will have to be materially higher than it is currently. This will require significant gains in employment and a return to a tight labour market. The board does not expect the conditions to be met until 2024 at the earliest. And what of Jobkeeper ending today? It's predicted that between 150,000 to 200,000 people currently on JobSeeker will be losing their jobs once the JobSeeker benefits ends today. It will be interesting to see whether this has any dramatic effects on the current economic recovery. Our economic recovery is still a long way away. Whether you choose to listen to reports that there will be an interest rate hike sooner than expected and that the property market will soon crash, that is up to you. But at the end of the day, the decision is up to the RBA, and I know I'll be keeping a close eye on the reports rather than reading speculations in the media. I hope I have explained the financial downturn that we went through in the last year or so. If this has brought up any concerns in regards to JobSeeker, I have provided some useful links below, including links to Rent Assistant, Family Tax Benefit, and National Debt Helpline. If you have liked what I have presented, please make sure to like and subscribe to my channel so I can bring you more free content like these. Thanks for watching!